Welcome to the deep dive. Today we're going to be taking a deep dive into Warren Buffett's 2003 letter to Berkshire Hathaway shareholders.
Oh, yeah.
We've got the original letter itself and then also some really insightful notes from someone who clearly knows their Buffett.
Right.
So you're in for a treat.
Yeah.
Buffett covered a lot that year, from market conditions and big acquisitions to his thoughts on corporate governance and even some personal investment strategies.
It's always fascinating to revisit these letters.
Yeah.
They offer such a cool glimpse into his thinking at a specific moment in time.
Right.
And they often hold valuable lessons that transcend any particular year.
Yeah, absolutely.
Yeah.
So let's unpack this 2003 letter.
Okay.
Right off the bat, Buffett talks about Berkshire's performance,
Mm-hmm.
a 21% increase in per-share book value,
Wow.
bringing it to a whopping $50,498.
Huge.
But here's where it gets interesting.
Okay.
He also mentions that book value, while a useful metric,
Yeah.
is becoming less relevant as a gauge for Berkshire's intrinsic value. What's going on there?
Well, you have to remember that Berkshire's portfolio was evolving.
Mm-hmm.
They were shifting from primarily owning stocks to owning entire businesses.
Right.
And those businesses don't fluctuate with the market as much as stocks do.
I see.
Plus, as Berkshire grows larger,
Yeah.
it becomes harder to find enough undervalued stocks to really move the needle.
Right.
That's why Buffett emphasizes that intrinsic value,
Mm-hmm.
what the business is truly worth,
Yeah.
based on its future earning power,
Yeah.
is becoming a more important measure than book value.
That makes sense, and it leads us to one of the more intriguing parts of the letter,
Okay.
the Clayton Homes acquisition.
Oh, yeah. This story is a classic example of how Buffett operates.
Mm.
He gets a book gifted to him by some finance students from the University of Tennessee,
Right.
connects with the CEO, sees the value in the business,
Yeah.
and bam, a deal is struck.
Wow.
Largely based on trust and a handshake. But what's fascinating is that this was happening against the backdrop of a struggling manufactured housing industry.
Yeah, I was wondering about that.
Yeah.
Like, there are all these problems
Mhm.
with bad lending practices,
Mm-hmm.
tons of repossessions.
Yeah, it was a mess.
It was a mess, but Clayton Homes seemed to stand apart.
They were the good guys of the industry, so to speak.
Right.
Buffett saw that Jim and Kevin Clayton
Mm-hmm.
ran a solid operation,
Yeah.
even in a tough market.
Yeah.
And then you have that full circle moment
Mm.
where Clayton ends up acquiring Oakwood Homes,
Right.
whose distressed debt Buffett had previously purchased.
Wow.
That's Buffett thinking long-term,
Mm-hmm.
seeing the potential for consolidation and improvement within the industry.
And let's not forget that Buffett gifted those Tennessee students Berkshire Hathaway Class B shares
Oh, wow.
for introducing him to Clayton Homes.
What a finder's fee.
It speaks volumes about Buffett's character, wouldn't you say?
Absolutely.
He believes in rewarding people who contribute value, even in unexpected ways.
Absolutely.
Okay, from manufactured homes to groceries.
Okay.
The McLean acquisition from Walmart is another interesting story.
Yeah,
And it happened the same year.
it did.
This deal really showcases the trust and efficiency that
Mhm.
Buffett values.
Yeah.
A 29-day turnaround with no traditional due diligence.
That's crazy.
That's almost unheard of.
Yeah.
It points to the strong relationships Buffett cultivates
Right.
and his ability to make quick decisions when he sees a good opportunity.
Totally.
He was very impressed by Walmart's efficiency,
Mm.
calling them the most admired company.
Yeah.
So 2 big acquisitions in 1 year.
Wow.
But Buffett also tackles a darker side of the corporate world.
Okay.
Tax.
This is where things get interesting.
Yeah, this is where things get interesting.
Yeah.
Buffett was publicly criticized for, quote-unquote, playing the tax code.
Really?
Yet Berkshire paid a staggering $3.3 billion in taxes that year.
Wow.
More than many giant corporations combined.
Yeah.
He points out the irony of being accused of tax dodging while
Wow.
being one of the largest corporate taxpayers in the country.
I see.
He goes on to say that while Berkshire's tax contributions are significant, the overall share of corporate income taxes and federal receipts is declining.
Interesting.
He's calling out those who exploit loopholes to avoid paying their fair share, isn't he?
Exactly.
It's a reminder that corporations have a responsibility to contribute to the system
Right.
that allows them to thrive.
Yeah.
And Buffett is not afraid to highlight those who aren't living up to that responsibility.
Totally.
From taxes, he moves on to another hot topic,
Okay.
CEO pay.
Oh.
And let's just say he doesn't hold back.
This was during a time of widespread outrage over excessive executive compensation.
It was.
Yeah.
And Buffett's critique is sharp. He calls out self-serving consultants, play money negotiations, and a lack of true independence on compensation committees.
Interesting.
He's basically saying the system is rigged to benefit CEOs. At the expense of shareholders.
Yeah.
He even compares CEO pay negotiations to playing with monopoly money.
Oh.
Highlighting how detached some CEOs are from the real-world impact of their compensation.
It's a powerful analogy, isn't it?
It is, yeah.
It gets to the heart of the problem.
Yeah.
But Buffett doesn't stop there.
No.
He also criticizes mutual fund directors. Arguing that many are not truly independent and fail to protect shareholder interests. Especially those who rely heavily on director fees for their income.
Interesting.
He suggests that mutual fund directors should be required to make specific declarations in annual reports about their manager selection and fee negotiation processes.
So more transparency is needed in his view.
Transparency and accountability, those are key themes in this letter.
Yeah.
And they come into play even more strongly when Buffett contrasts this with Berkshire's own governance model.
Berkshire's directors have significant skin in the game.
They do.
They own millions of dollars worth of Berkshire stock.
Wow.
Aligning their interests directly with shareholders. They also don't carry directors' and officers' liability insurance.
Wow.
Their fate is tied to the company's performance.
Talk about accountability.
It's a fascinating approach built on shared risk and reward.
It is.
But even the Oracle of Omaha makes mistakes.
Oh, no.
And he's incredibly open about one in this letter.
Okay.
The Gen Re securities situation.
Yeah.
He admits to delaying the closure of this derivatives-heavy operation, costing Berkshire millions.
Oh.
I love how he puts it, quote,
Okay.
I'm sure I could have saved you $100 million or so if I had acted more promptly.
Wow.
End quote.
That's a lot of money.
It's refreshing to see that level of honesty and self-awareness from someone of his stature.
It is.
And he uses this experience to warn investors about the dangers of derivatives, even for sophisticated investors.
Yeah.
He believes you simply can't fully grasp the risks lurking within these complex financial instruments. It's a reminder that complexity can breed danger even for the brightest minds.
It can.
But let's shift gears from the corporate world to the global economy.
Okay.
Buffett expresses concerns about the U.S. dollar.
This is where Buffett's macro perspective comes into play.
Yeah.
He's worried about the growing U.S. trade deficit
and
the potential consequences of a world flooded with dollars.
It's interesting because he admits that macroeconomic forecasts are notoriously difficult to get right.
Oh, for sure.
But his concerns led him to make a move that was unusual for him.
What was that?
He entered the foreign currency market for the first time.
Wow.
Buying contracts to hedge against the dollar's decline.
I see.
It shows his willingness to adapt and protect Berkshire's assets in a changing global landscape.
It does.
But what I found fascinating is his default position.
Okay.
When he can't find anything exciting to invest in, he turns to U.S. Treasuries.
Oh.
Safety and stability, overreaching for yield, even when rates are low.
Interesting.
What do you think about that approach?
It highlights the importance of discipline and patience in investing. Sometimes the best move is to wait for the right opportunities. Even if it means sitting on the sidelines for a while.
And speaking of learning and patience, Buffett concludes the letter with a few book recommendations.
It's always insightful to see what's on Buffett's reading list.
It is.
In 2003, he highlighted Bull by Maggie Mahar, The Smartest Guys in the Room, and a revised edition of The Intelligent Investor, a classic. Clearly, he believes in lifelong learning and gleaning wisdom from others' experiences.
So we've covered a lot of ground in this first part of our deep dive into Buffett's 2003 letter.
We have.
We've seen his thoughts on market conditions, acquisitions, corporate governance, taxes, CEO pay, and even the global economy. But we've only scratched the surface of this incredibly rich document.
There's so much more to uncover.
There is.
Next, we'll delve deeper into Berkshire's performance sector by sector.
Okay.
Get ready for a fascinating journey through the diverse world of Berkshire Hathaway.
Sounds good. Ready to delve deeper into Berkshire's sector-by-sector performance.
Let's dive in. As you know, Berkshire's operations are incredibly diverse.
Yeah, it's like a sprawling empire of businesses, each with its own unique story. And it all starts with insurance. The heart of Berkshire's operations. Buffett even calls it, quote, where the money is, end quote.
He does.
And I'm sure you know why.
He's talking about float, right?
That's right.
That pool of money insurers get to hold and invest before they have to pay out claims.
Right.
And in 2003, Berkshire's float reached a record high.
Wow.
Topping $44 billion.
That's a lot of money.
The beauty of float is that it acts as free capital, especially if you can underwrite profitably.
And Buffett repeatedly praises Berkshire's insurance managers for consistently achieving profitable underwriting.
Right.
He emphasizes that this industry requires brains discipline and integrity because anyone can copy another company's product.
Right.
This really gets to the core of Buffett's management philosophy.
It does.
Find the right people and let them do what they do best.
Absolutely.
And speaking of finding the right people, Gen Re, which had previously been a problem child for Berkshire, was finally turning things around.
Yeah, finally.
Yes. Buffett gives a lot of credit to Joe Brandon and Ted Montross for fixing Gen Re by restoring discipline in both underwriting and reserving. He even points out that Gen Re, along with National Indemnity, were the only two AAA-rated reinsurers in the world at that time.
That's impressive.
It's a good reminder that financial strength is paramount.
Yes.
Especially in an industry like insurance that deals with huge and often unpredictable risks.
Absolutely.
And speaking of huge and unpredictable risks, we have to talk about Ajit Jain, the maestro of Berkshire's supersized reinsurance operation.
What a guy.
This is the guy who insured against those billion-dollar Pepsi giveaways, right?
That's him.
That's him. Ajit's business is all about taking on these unusual, massive risks that nobody else wants to touch.
Right.
Buffett even admits that Ajit's results can be lumpy with the occasional horrible year.
It happens.
But as we know, over the long haul, it's proven to be a winning strategy.
Precisely.
And then there's Geico, the auto insurance powerhouse that just keeps growing under Tony Nicely's leadership.
Yeah, he's done a great job.
Premium volume more than tripled during his time there.
Wow.
Buffett even throws in a little commercial for Geico in the letter.
Classic Buffett humor.
Classic Buffett, yeah.
But it shows how proud he is of Geico's success and their commitment to saving policyholders money.
Right.
He even praises their expansion into Buffalo, New York.
Yeah.
Thanking Governor Pataki for helping bring 2,500 new jobs to the city.
From auto insurance, we move to utilities.
Okay.
A sector that Buffett has always liked.
He has.
Berkshire owns a huge chunk of Mid-American Energy Holdings.
They do.
Which has a diverse portfolio of utility operations. From electricity distribution in the UK to pipelines carrying natural gas across the U.S.
Wow, that's diverse.
This investment speaks to Buffett's belief in regulated utilities as stable long-term investments.
They are.
He explains that Berkshire's voting interest in Mid-American is limited due to regulations, but their financial partnership is strong.
I see.
And Buffett shares an interesting anecdote about how the UK utilities actually became more efficient after privatization.
Interesting.
He attributes this to the motivating power of profit-driven managers, even within a regulated environment.
It's a nuanced perspective.
It is.
Recognizing that both regulation and market forces can play a role in driving efficiency.
Right, but let's not forget the non-utility star in Mid-American's portfolio.
Right.
Home Services of America. Yes, Home Services, led by the exceptional Ron Peltier, is a real estate brokerage giant.
That's right.
They were already the second largest real estate broker in the country in 2003.
Wow.
And Buffett clearly saw the potential for even greater growth.
He did.
Moving on from utilities.
Okay.
Let's look at Berkshire's operations in finance and financial products.
All right.
This is where things get a bit more complex.
This is where we get into the weeds a little bit.
And this is where Buffett had to confront some tough lessons, especially with Gen Re Securities.
Ah, yes, the derivatives business.
While Buffett was in the process of winding it down, he acknowledges that he could have acted more swiftly and decisively, which would have saved Berkshire a significant amount of money.
Of course.
He's very frank about his misjudgment.
He is a very honest guy.
And he uses this experience to sound the alarm about the inherent dangers of derivatives. He emphasizes that even for those who think they understand them, You can never fully grasp the risks associated with these complex instruments.
It's true.
It's a stark reminder that even the most brilliant investors can get burned by things they don't completely comprehend.
Couldn't agree more. It's a lesson for all of us, not just financial professionals.
Yeah, absolutely. But within this sector, Buffett also points out some brighter spots, including his own profitable strategies in AAA fixed income securities, and Ajit Jain's innovative life and annuity business, which involved arbitraging money.
Interesting.
These examples illustrate the wide range of Berkshire's financial activities and their ability to capitalize on opportunities in various market conditions.
Impressive.
But it's not all about numbers and balance sheets, is it?
No, it's not.
No. Buffett also takes time to address a controversy that led to the termination of Berkshire's shareholder designated gifts program.
This was a tough decision for Buffett and Charlie Munger.
Yeah, it was.
Boycotts were impacting the independent associates of the Pampered Chef, a Berkshire subsidiary. And they felt it was more important to prioritize the well-being of those who relied on Berkshire-affiliated businesses than to simply focus on tax efficiency.
It's a powerful example of their values in action.
It is.
It's putting people ahead of profits.
Absolutely.
But don't worry, the letter isn't all serious business. Buffett ends with a lighthearted preview of the upcoming Berkshire Hathaway annual meeting.
Woodstock for capitalists.
He paints a vivid picture of the event.
He does.
From the expanded exhibition space, showcasing Berkshire's diverse subsidiaries, to the shareholder discounts at Nebraska Furniture Mart and Borsheim's.
Oh, nice.
And who could resist the allure of playing bridge with world champion Bob Hammond? Or challenging chess grandmaster Patrick Wolf to a blindfolded match?
That sounds fun.
It's clear that Buffett loves these annual gatherings.
He does.
As much as the shareholders do. Creating a unique experience that celebrates the Berkshire community.
Absolutely. This letter really is a masterclass in communication.
It is.
He seamlessly blends financial insights with personal anecdotes, humor, and even a bit of philosophy. It's more than just a report on Berkshire's performance. It's a glimpse into Warren Buffett's mind, his values, and his enduring belief in the power of long-term value-driven investing.
But there's still one crucial sector we haven't explored yet.
What's that?
The engine that drives so much of Berkshire's success. Manufacturing service and retailing operations, from carpet to candy, furniture to private jets.
Wow.
This sector showcases the tangible products and services that underpin Berkshire's vast and diverse holdings. We've talked about insurance, utilities, and finance. Now let's explore the world of Berkshire's manufacturing service and retailing operations. This is where we see Buffett's love for solid, well-managed companies that produce the things people actually need and use.
You're absolutely right. This sector represents the backbone of Berkshire Hathaway, a diverse collection of companies, each with a unique story and a history of strong performance.
Buffett provides a snapshot of the sector's combined performance in 2003, showing a 20.7% return on tangible net worth.
Wow.
That's impressive, wouldn't you say?
It certainly highlights the consistent earning power of these businesses. But as always, Buffett provides context. He reminds us that Berkshire acquired these companies at a premium to their net worth, which is reflected in the goodwill on their balance sheet.
I see.
This reduces the return on their average carrying value to 9.2%. Still a respectable return. But a reminder that acquisitions come at a price.
It's a good lesson for any investor to look beyond the headline numbers and understand the true cost of an investment.
Absolutely.
Now let's break down this diverse sector and look at some of its key players. What stands out to you?
Well, we could start with building materials. Acme Brick, Benjamin Moore, Mytek. These are names and products you see everywhere. They all had record operating earnings in 2003.
These businesses are a classic example of a Buffett investment, aren't they?
They are.
Essential products for the housing and construction industry. They're not flashy or particularly exciting, but they are steady earners.
Exactly. They provide the building blocks, literally and figuratively, for a growing economy. And then you have Shaw Industries, the world's largest carpet manufacturer. They also had a record year, thanks to the leadership of the founder, Bob Shaw.
Buffett seems to have a deep appreciation for these entrepreneurial success stories, doesn't he?
He is
building a company from the ground up into a global leader like Bob Shaw did.
He sees the value in that kind of drive and vision. And he notes that Shaw acquired additional carpet operations from Dixie Group that year, further solidifying their market position.
From flooring, we move to well underwear. Fruit of the Loom, a 148-year-old brand, is Berkshire's main player in the apparel market.
Oh, yeah.
Can you tell us more about that?
Of course, Fruit of the Loom dominated the men's and boys' underwear market with a massive 42.3% share sold by mass marketers like Walmart and Target.
Wow.
And they were making inroads in the women's and girls' market as well.
So what's the secret to their success?
Buffett attributes it to a combination of factors, a strong brand, low-cost manufacturing, and a talented CEO in John Holland.
Okay.
It's a recipe for success that you see repeated across many industries.
And let's not forget See's Candies.
Oh, yes.
It's a beloved American tradition and a consistent earner for Berkshire.
It's a great example of a business with a strong brand identity and a loyal customer base.
See's falls into Berkshire's retail category, along with the furniture giants Nebraska Furniture Mart and R.C. Willey.
Right.
They both opened hugely successful new stores in 2003.
Wow.
One in Kansas City and the other in Las Vegas.
That's a big expansion.
These are businesses that benefit tremendously from economies of scale.
They do.
Nebraska Furniture Mart's Kansas City store was believed to be the largest volume home furnishing store in the country at that time.
Huge.
They even received a presidential shout-out for their job creation.
Wow.
Although President Bush mistakenly took credit for their success.
Talk about a marketing coup.
Clearly, Buffett has a knack for finding businesses that resonate with everyday Americans.
Absolutely. And he's not afraid to inject a bit of humor into his storytelling.
No, he's not.
Remember the anecdote about Mrs. B's furniture store and her advice on low prices?
Yes.
If you have the lowest price, customers will find you at the bottom of a river.
Classic Mrs. B. From furniture, we move to flight services. Berkshire owns Flight Safety, a leading pilot training operation, and NetJets, the pioneer of fractional aircraft ownership.
It's a pretty cool concept.
Flight Safety was facing a downturn due to the slowdown in corporate aviation in 2003.
I see.
But they remained the industry leader with their impressive array of flight simulators. And NetJets, while facing losses in Europe, was still the dominant player in the fractional ownership market.
Yeah, they were way ahead of their time.
Buffett expresses confidence in NetJets' long-term potential, emphasizing their commitment to customer satisfaction, safety, and global reach.
That's important.
He even mentions the unique Mayo Clinic Executive Travel Response Program.
Oh, wow.
A free benefit for NetJets owners, providing immediate access to medical expertise anywhere in the world.
That's an incredible perk.
It shows that Buffett understands the importance of going above and beyond for customers.
It's about building trust and loyalty, which are essential for any business aiming for long-term success.
Yeah.
It's about creating a brand that represents not just a product or service, but an experience, a way of life.
And that brings us to the end of our deep dive into Warren Buffett's 2003 letter to Berkshire Hathaway shareholders.
Wow, what a journey.
We've covered a lot of ground, haven't we?
We have from market insights and acquisition stories to corporate governance debates and personal investment strategies. It's been quite a ride.
It's a letter brimming with wisdom and wit.
It is.
And although it was written over 20 years ago, the principles and insights it contains are timeless and relevant for investors today.
I completely agree.
So what are your key takeaways from this deep dive?
For me, it's Buffett's unwavering commitment to long-term value creation. His emphasis on finding exceptional managers and giving them the freedom to operate. And his remarkable willingness to acknowledge and learn from his mistakes.
I completely agree. It's a powerful reminder that investing is a marathon, not a sprint.
It is.
Building a successful business requires patience, discipline, and a focus on the fundamentals.
Couldn't have said it better myself.
And who knows, maybe one day we'll find ourselves at that Woodstock for capitalists in Omaha.
I hope so.
Sharing a Coke with the Oracle himself.
That would be amazing.
Until then, keep learning, keep questioning, and keep seeking those nuggets of wisdom that can help you navigate your own investing journey.
That's great advice. Thanks for having me.
Thanks for joining us on this deep dive. We'll see you next time, ready to explore another fascinating topic.